Hey folks, Dan Frio here, the Opening Bell with Dan Frio. I, of course, am Dan Frio, and I want to go over today what's going on in the market. We're all basically on the edge of our seats waiting for Federal Chairman Powell to come out and tell us what the Federal Reserve plans is, or are, or going to be, because we had the stimulus pass, that's starting to go out, and now we want to see what the Fed's going to do because the excess money pumping into the system is causing the Fed to fear inflation. So are they going to act now, or are they going to do it later? Okay, so what's the big hype about inflation? Well, basically, inflation, let's just say it eats away at corporate profits. Let's just leave it at that because it's devaluing the dollar and the dollar is worth less and so forth. So it's devaluing the dollar. The other piece of the puzzle is what is it doing to treasuries, especially the 10-year treasury. So I'm going to explain to you, how that will detract people from buying stocks and moving them into treasuries or bonds. And again, if you have a finite amount of product and you have less demand, it's going to bring down the prices. So if people move out of stocks, which will be less demand, moving them into bonds, it's going to drive down the prices of stocks. So let's dig into today's activities. And basically, the whole market is going to be based off of what the Fed comes out and says. So I hope it's not bad news because the market could get crushed. So let's get into the headlines. You can see Amazon just went past Walmart is the #1 retail apparel store in the U.S. But the headline news is right here. I'm going to go through a couple different sections to just show you what's going on. Fed must walk a fine line as financial markets hang on the balance. So again, guys, it's the economy, which it shouldn't be. It should be based off of production and employment and profitability of companies and everything right now. But it is so, I'll say it's artificially inflated because of such cheap money. Here's a good analogy that I make. Is I personally met with my financial advisor, and we sat down and said, do we pay off my house, or do we use the excess money that I would put into the house payments or the amount of money I have set aside and to pay off the house? Do we put that in the market? Okay, so here's basically the backdrop of this. If I refinanced my home at 2.625 on a 30-year term. So my cost of funds is 2.625. My yield last year was approximately 17 to 20% on my portfolio. So do I borrow money at 2.5 and get a return of 18, 19%? Yeah, makes financial sense. But you might say, well, Dan, how about if the market turns? Okay, so that's a great comeback, but historically, yields are approximately 8%, 8 to 10% in the markets. We're in investments. That's if you go back in history, at least 8%. Okay, so you're going to have the ups and downs. You're going to have the markets where it's down 15, 20% one year, and the next year it's up 30 and so forth. But over time, over the longevity of things, it yields 8. So if I can basically, in essence, in this way, we'll say we borrow money at 2.5 or 2.625, and we get a rate of return of 8. I got a spread there that makes sense. So that is my money that is growing. Plus the inflation index is going to run 2. I think it's going to hit 4 within the next 6 to 8 months. But the Fed's still saying, you know what, we're watching in the employment numbers. So let's say that's the case. So again, do you understand what I'm saying? It's predicated to you and your opinions, but if you're more comfortable paying off your house, pay off your house. If you're more comfortable saying, or financially, you look at the numbers, you're going to say, well, I can borrow it 2. Let's just round it. I can borrow it 3 and get 8. I can get a 5% spread on my money. Not a bad way to do it, but I'm not telling you guys what to do. I'm telling you what I'm doing. So the channel is basically to educate you guys and entertain you guys on finances. And we talk stocks, crypto, real estate, and bonds. So let's get on to what the headlines of the markets are saying. Basically, we all know the pandemic bill, or the CARES Act, the new $1.9 trillion stimulus package has passed. Now they're working on another $1 to $2 trillion infrastructure bill, which is very much needed. but I want to just see how much pork is built into that thing. That's what frustrates me. It's not helping people or helping the economy or building the economy, folks. It's the waste, the pure waste involved in a lot of this stuff. So the headline news is basically the Fed. Let's go to the next one. Stock market's mixed ahead of Fed decisions as tech stocks slide. So normally what happens in an environment of higher rates, people get out of, I'll say, more speculative stocks, let's say the tech sector, and they get into things such as oil, gold, commodities right here. So there's something tangible that you can grab. So you're going to see probably gold going up, cryptocurrencies. That's a whole kind of different realm. But you're going to see gold going up. What other? Lumber, as we see lumber, commodities in general are going to go up. So that's basically the headlines right now. So we're going to focus on that right now, and what my thoughts are, where my money's moving right now and has been over the last couple weeks because of this stuff. So one of the things that we focus on is the 10-year Treasury versus the S&P 500 dividend yield. We're using the S&P 500 dividend yield as a benchmark, so it's here. The spread between the 10-year Treasury yield and the S&P 500 yield was all the way down here back in 2020. But Treasury yields are on the move. They're going up and up and up and up and up. Now they're equal to, and probably very shortly going to exceed, the S&P 500 dividend yield. So what that tells wealth advisors, financial planners, is, I need to start shifting more of my assets into treasuries, okay? Treasuries, not just general bonds in general, but treasuries. So that's why we're seeing a run-up. Well, we're seeing a run-up in the treasury because of the fear of inflation. But as it hits and peaks over the 500 S&P 500 dividend yield, you're going to see, well, let's retract. Let me say this and then I'll retract back. You're going to see a move from stocks into the treasuries. However, because the Fed keeps pumping money into the system, people are still going to say, okay, I got a ton of money. I only want to allocate X amount of my money into 10-year treasuries or treasuries in general, so I still have that excess money. So there's going to be, Federal Chairman Powell's going to come out today, and I'm hoping that he's going to tell us what they think the savings rate is going to be on the stimulus package. Here's what I mean by that is, the last stimulus checks that went out, 30% of the money was put into investments or savings for people. So if all that money gets pumped into the system and goes into savings, which is bonds, stocks, cryptocurrency, and so forth, there's going to be excess money. People allocate X percentage of their money into treasuries, X percent of their money into stocks. So you're still going to have extra money into markets that are still going to continue to push up stocks and still going to push up yields on the treasuries. So it's kind of a whirlwind win-win-win-win-win. However, when the party's over, then what? Well, let's say it this way. Let's worry about that at that time, because I don't think anything's really going to change for the next 6 to 8 months at least. Let's focus on the today, and we'll focus on that time period as we get closer to when I think things are really going to start to pop. So now let's get on to our watch list. We have our staples that we always look at. Google, Apple, and Facebook. Let's see what they're doing. They're down 1%, down 2%, down 0.8%. So not bad, but you're going to see a ton of red here. Okay, this is a watch list that I go through each day, and I try to follow those that are, if something really pops out, like in this. If you're looking at this and you see all red and a couple greens, what are those green areas? Okay, well, let's look at this. We have, and let's go to the top. Let's see. Okay, the greens, Berkshire Hathaway. It's basically, we'll say 0. But now we're getting into canopy growth. It's cannabis. We've been talking about cannabis. This is a way to play cannabis. Load, they mine gold and silver. It's up 8% today. Another cannabis stock up 0.25%. Guys, just think this 0.25%, you don't get that in your checking or savings account, okay? You get probably you might get this in your checking account for the year, okay? This is a move for a day. And I know this is, you can't take this because it might be down tomorrow and whatever. But what I'm getting at is, even a 1% yield is better than you're getting in your savings account. All right. The other thing is the S&P 500 oil and gas index. It's in the green. Not much, but it's in the green. NASDAQ bulls, I don't know why that's in the green because the NASDAQ is down, but it is what it is. Facebook's up, or at least steady. We go to another area, energy, up, it's green. Again, guys, not much, but it's something. We'll continue to go down. We got XLF. That's one of those positions that I've been adding to. All right, so that's, do you see what I'm talking about? You track a ton of stuff just to see what areas are working, okay? So that's the areas so we'll focus on. Here's the positions that I've been adding to, and I've been vocal about this. I'm looking at Ford for my electric vehicle play. Okay, it's an inexpensive stock. You can add to the positions fairly, relatively easy and cheap, and it's a very, very, very good company. The other areas I've been adding to on a basically a weekly or bi-weekly basis is my cryptocurrencies. Those are Bitcoin Cash, Bitcoin, and Ethereum. Okay, those are these areas right here. They're all down like 3%, but they could be up 20% tomorrow. Who knows? So this is my really speculative play. Other areas I've been looking at or added to my position is RYE. It's the S&P 500 Weighted Energy Index. It's in the green. Okay, we're starting to move our assets into commodities energy. The other area that we look at is XLF. This is a basket of financials. When interest rates are on the climb, this is the position to be in. XLF is my position because it holds positions in all of the major financial companies out there. All right. Then my getting out of the pandemic mode is my Disney. It's down 1% today, but it's had a nice run. Why Disney? Very well managed company. The Disney cable stuff is just doing fantastic. Once the parks open up, especially you got spring break coming up, once the parks open up, the cruise ships start to get back to full capacity, they're going to blow out the numbers. And it might not be next week or next month, but in the long term, this is a great opportunity to get in on that. Then the other area that I've been adding to my positions as well as my children is Berkshire Hathaway. They don't have the ability to follow stocks, but how do you get professionally managed cheaply? Right here, Berkshire Hathaway, BRK/B. That's the B shares that are a fraction of the A shares. So it's the same stuff, guys. It's just a factored or a fractioned share price. We'll put it that way. Okay, so that's those areas that we're focusing on right now. What's going on with the cryptocurrencies? Well, we can see Bitcoin is down. Well, this is basically, we'll say zero. So Bitcoin and Ethereum are completely flat. We'll go to the other positions I hold in. I hold Litecoin, which is down 0.5%. So I'll say flat, and Bitcoin Cash. Those are the positions that I hold. There are slews, I don't know if that's a word. There's a ton of cryptocurrencies. So when you have this much of a field, let's say these are a whole bunch of players that you're looking to recruit. Well, if you could get the number one player in the country, why wouldn't you do that? Yes, you could do these. This is a speculative play anyways, guys. So why wouldn't you take the cream of the crop, at least, that all, huge institutional investors are getting into, that you basically know this won't immediately go to zero, so you have an exit strategy if things really hit hard. But this is the cream of the crop, Bitcoin. The platform that a lot of these cryptocurrencies run on and other technology is the Ethereum platform. Okay, so this is the internet, and this is Amazon. So if you want to buy Amazon, or something through Amazon, you have to use the internet to do that transaction. Well, when you do that transaction, Ethereum makes money as you're buying or adding to your positions in Bitcoin and a lot of other cryptocurrencies. So that's why I hold positions in both of these, pretty much equal to in both of these, believe it or not. What's going on with the US dollar? Well, it's going up again. My benchmark that I'm looking for is this to hit 90. Let's see where we are on our trend. We're above the line, which to me is saying that the dollar is stronger than it should be. And with the stimulus package and everything else that went out, the dilution of the dollar is going to come. Trust me, it will come. It has to come eventually. Is that doom and gloom? No. But I'm just saying the value of the dollar has to deplete because of how much money that we're throwing into the economy. Okay, so now let's get to the nitty gritty of what I do for a living. I'm a mortgage person. I've been doing mortgages for 33 years. We focus here. This is the area that I focus on every night. I post between 4 and 5 o'clock every night what's going on with mortgage rates in the real estate market. This is what we focus on right here, this number here. This is the mortgage-backed security, the price of a mortgage-backed security bond. And let me just tell you how this works. When this number, the price of the bond goes down, which it's going through right here, as this price goes down, mortgage rates go up. The bigger this number, the bigger the rate increase is. So let me say, 25 basis points isn't huge. It's big enough to probably cause rates to go up 0.1 or 0.2% today. Okay? Well, rates are up most likely about 0.5% from here to here. Okay, so don't be surprised if you got pre-approved, back when at 2.875 and now you're at 3.25 or 3.375, possibly even running maybe hot at 3.5, depends on when you look to lock. So what we try to do on our end is we try to, as we're taking your application, we monitor what's going on in the market. So if the market's on the uptrend, meaning when the price goes up, rates come down, we're not locking you. I watch this all day, every day, as well as a bunch of other technicals, and I can usually kind of see a little crystal ball here of what's going on. So if I see the market completely deteriorating, I'm going to lock you in. So this is giving you a day-to-day trend of what's happening, but if you really go in with a microscope, you can see what I see on a daily basis, which is this. So this is what's going on right now. So again, as this goes up, mortgage rates are coming down. So we came out of the market, we crashed. Okay, so now we're on a little bit of a recovery. These green candlesticks mean there's more buyers than sellers. That's a good note. Okay, so that's a good note. So somebody knee-jerked, or a bunch of people knee-jerked this morning and sold off a lot of their positions, and then they're adding to those as the day goes on, and things are getting a little bit better. So I like this trend, but again, everything is hinging upon what the Federal Reserve is going to do today at 2 o'clock Eastern, 1 o'clock Central. So thanks guys for watching. I hope you learned something. Please come back today and every day around 4 or 5 o'clock for my rate update with Dan Frio. And I'm here to educate and entertain you guys. All I ask is give me a thumbs up. If you would, please subscribe down below. Hit the bell so every time I post a video, you get an alert. God bless. Have a profitable day. See you later. Bye-bye.